This is VeriScope News, verified information, clear context. We provide the facts required to understand the global economy without speculation or alarm. The beginning of 2026 marks a transition point for global financial stability. Following a year of significant equity growth in 2025, the international community is now focused on the sustainability of current economic trends. This period is defined by a shift from synchronized global inflation management to a more fragmented landscape of national policies. Understanding these shifts is essential for maintaining a clear perspective on the long-term health of the global financial system. The current market landscape is centered on three primary pillars. First is the leadership of the United States Federal Reserve. With Jerome Powell's term concluding in May, the nomination process is currently underway. This selection is viewed by institutional investors as a signal for the future of central bank independence. Second, analysts are monitoring the divergence of interest rate paths. While the United States has initiated a cycle of rate reductions, other major economies like Japan and Australia are moving toward tightening. Third, the year is punctuated by significant political milestones, most notably the United States midterm elections in November and major leadership contests in Brazil, Colombia, and Hungary. These events create a backdrop of policy uncertainty that influences capital flows. To understand 2026, one must look at the trajectory of the previous 2 years. The global economy spent much of 2024 and 2025 navigating the aftermath of high inflation and the subsequent rapid rise in interest rates. By the end of 2025, many markets reached record highs, fueled largely by the expansion of artificial intelligence infrastructure and resilient consumer spending. However, the historical trend of higher for longer borrowing costs has not fully dissipated. Even as central banks begin to lower the short-term overnight rates, the long-term bond markets, which dictate mortgage and corporate debt costs, remain elevated. This reflects a historical pattern where fiscal deficits and government borrowing levels begin to weigh more heavily on market sentiment than the immediate actions of central bank committees. The impact of the 2026 outlook is most visible within household finances and the broader cost of living. While the Federal Reserve is expected to continue reducing the federal funds rate, the immediate relief for households may be limited. This is because long-term borrowing indicators such as the 30-year mortgage rate are more closely tied to the 10-year Treasury yield. Current forecasts suggest these yields will remain near 4.25%. For the average household, this means that while credit card interest may decrease slightly, the cost of entering the housing market or refinancing existing debt remains high compared to the previous decade. Regarding prices and inflation, a significant risk factor is the potential for aggressive easing. If the Federal Reserve reduces rates more quickly than economic productivity justifies, there is a risk of reigniting inflationary pressures. This would keep the cost of essential goods, such as energy and groceries, at their currently elevated levels. Conversely, the expected strengthening of the Japanese yen against the dollar suggests a shift in global trade dynamics. A weaker dollar generally makes imported goods more expensive for American consumers while making exports more competitive. The employment market is entering a phase of rotation. While the massive investments in artificial intelligence continue to drive growth in the technology sector, there are emerging doubts regarding the immediate return on these investments. This could lead to a stabilization of hiring in tech-heavy regions as firms focus on profitability over expansion. In the broader economy, the high cost of corporate debt may limit the ability of small and medium-sized businesses to expand their workforce. For savings and investment portfolios, the landscape is one of moderated expectations. Analysts project the S&P 500 to grow by approximately 9% this year, a sharp decline from the double-digit gains seen in 2025. This suggests that the easy gains of the post-inflation recovery have been realized. Investors are now looking toward a broader rotation. Instead of focusing solely on a few mega-cap technology companies, capital is beginning to move into a wider variety of sectors, including energy and utilities, as the market prepares for a potential correction. Businesses are currently operating in an environment of high fiscal sensitivity. The U.S. Supreme Court is expected to rule on the legality of emergency tariffs, a decision that will dictate supply chain costs for thousands of manufacturers. If tariffs are upheld, businesses will face higher input costs, which are typically passed on to the consumer. Furthermore, the high level of sovereign debt across major economies means that governments have less room to provide fiscal stimulus if a slowdown occurs. Market observers are prioritizing 3 specific indicators over the coming months. The first is the nomination of the Fed chair. The background and policy leanings of the nominee will provide the most significant signal for inflation targets through the end of the decade. The second indicator is the performance of the Japanese yen. As the Bank of Japan raises rates toward 1%, the carry trade, where investors borrow yen cheaply to invest elsewhere, could unwind, causing volatility in global stocks. The third indicator is the mid-year earnings from the AI sector. These reports will confirm whether the billions of dollars spent on infrastructure are translating into actual revenue growth, or if the sector is entering a cooling period. For the individual viewer, the 2026 outlook suggests a year of consolidation rather than rapid expansion. It is a period to prioritize financial stability and the management of high-interest debt. The divergence in global rates means that international diversification may behave differently than in previous years. While the headlines may focus on political volatility and election cycles, the underlying economic reality is defined by the gradual normalization of interest rates and the reevaluation of technology valuations. Maintaining a long-term perspective is the most effective way to navigate this transition. In considering the broader movement of markets, it is helpful to observe the steady nature of infrastructure and logistics. Daily commerce continues despite the fluctuations of electronic tickers. Global shipping lanes remain active, and the physical expansion of data centers provides a tangible foundation for the digital economy. These structural elements of the economy often move at a slower, more predictable pace than the daily news cycle. By observing the long-term development of energy grids and transportation networks, one can find a sense of continuity. The underlying mechanics of trade and production are resilient, providing a stabilizing force even during periods of significant policy change or leadership transitions at the highest levels of finance. The information presented is based on current market data and consensus forecasts as of January 2026. At VeriScope, we focus on the data that shapes your world, providing context without the noise. We will continue to monitor these developments as the year unfolds. Thank you for your time.